Okay, folks, so we've got a lot to get ready for. Number one, Goldman Sachs just gave us 5 possible reasons for the market rally that we experienced last week. We had one of the best weeks that we had in over a year, and we need to explain whether these factors are going to continue to play out over this week. They actually said a few things that are very, very bullish for growth stocks. We'll talk about them. Then number 2, and the main entree this lovely evening, there is one stock that we talked in depth about on Thursday's video, which got us a decent amount of controversy if I'm being honest. And with it going parabolic another day, up over 20% on Friday and getting a ton more attention over this weekend, we need to discuss it before this week starts. Is there more than meets the eye with this trade, or is it just hype? We had some pretty big concerns from some of our viewers, and I need to address that in this video. Timestamps below, but let's get right into it, folks. Okay, so after stocks rallied last week for their best week since 2020, there are a lot of different takes on what happened. Lots of people are looking at this and they're saying, I ain't falling for that one. Not again. And others are saying this is the turnaround. We've reached peak fear and now we're bouncing off past these levels. Goldman Sachs analyst Chris Hussey believes the market is looking ahead to brighter days and that's why it's bouncing. Here's a direct quote. If the pandemic reminded investors of anything, stock markets are very forward-looking and can have a penchant to discount very different environments far before we experience it. And then they gave 5 reasons the market bounced back last week, which I then put into a spreadsheet. Number 1, they said people are learning to live with COVID, removing that cloud from the markets. I don't know that I'd personally cite this as a big reason that markets bounced last week, but it's certainly true that markets have become less and less reactive to COVID and COVID fears, and there's been less for it to react to. I do think that overall people and governments, except for China, have become desensitized to the threat of COVID, and people are expecting less and less restrictions even if we do get future outbreaks. But as we've seen in the past, reversals can happen, and we will see if this trend continues as increasingly Europe and Asia see outbreaks. Experts told Forbes that what happens in Europe, and especially in the UK, tends to happen in the US with a few weeks lag. The second point the Goldman Sachs analyst makes is that the Fed's aggressive plan will, in his words, lower inflation. This was a bit of a head scratcher for me because obviously I'm not a huge believer that a little pansy quarter rate hike is going to do much to curtail 7.9% on the CPI, especially given a lot of these pressures are commodity driven and commodities aren't something that the Fed has a lot of control over, not to mention a lot of the other supply chains that are still pretty broken. In my view, what the Fed is really doing right now is just deciding that we're not going to be stoking the flames anymore. But here's an important clarification from Goldman Sachs. They said the Fed's commitment to pushing against inflation today, this was written last week, even at the expense of growth, may be interpreted as a bullish sign for risk assets 12 to 18 months from now. They are kind of saying that the Fed signaled that it'll do what it takes to bring down inflation, and most of those impacts are going to be felt over a 12 to 18 month time horizon. Within that period of time, not only will the Fed have gone through about 7+ rate hikes, but you'll also have substantial time for the geopolitical tension to calm down. You'll have time for oil to drop dramatically. You'll have time for supply chains to ease and loosen up. So within the next 12 to 18 months, they're saying, hey, risk assets are starting to look better and better because inflation's looking like it's going to go down. This is at its core a light at the end of the tunnel argument. Obviously, markets aren't necessarily buying what happens today. They're buying what they think is going to happen 12 to 18 months from now and beyond. Similar to how markets bought up to an extreme extent massive dips in companies that were basically locked down for the entirety of 2020, way before they even started recovering meaningfully. Number 3, they said oil prices were seen as peaking. Investors may have seen the oil drop to near $100 after the massive $130 a barrel height, which if you remember happened somewhere around where Biden announced sanctions on Russian oil and gas. Goldman Sachs is saying that they saw that as a reminder that there can be a counter to commodity inflation. Obviously, if the risk of energy supply shortages go down, then that is a huge deflationary pressure and prices drop dramatically. And they're saying that last week investors were reminded of that fact because prices did drop dramatically. Now they are right now on their way back up, so we'll see how that plays out this week. But at least when you're talking about the factors that are driving this market, this is a big one. To me, it doesn't seem like energy prices are going to go down meaningfully as long as this Ukraine-Russia situation is escalating. It seems like you need substantial de-escalation for that to happen. Number 4, and this is their words, not mine, U.S. growth is, quote, strong. They cited housing starts are coming in better than expected, and airlines are expecting a surge in travel demand. But most importantly, they said, meanwhile, at Goldman Sachs, and as we know others, people have been downgrading economic GDP growth projections for the entire year. And so when you have a super low expectation, what happens? Well, it becomes a lot easier for the economy to beat those expectations. So they're saying that this week at least, the market started anticipating that the economy might actually beat the expectations that people have been projecting. And then lastly, number 5, geopolitical risks may fade. Market seems to be increasingly anticipating an upside scenario, and perhaps the suggestion here is that the market has already factored in much of the geopolitical escalation over in Russia and Ukraine and is now looking for a reversal of risk and thus able to rebuy back into the markets. Obviously, people always oversell news to be safe, and then when you oversold something, you have to go and buy it back up to the appropriate risk level. And last week, you saw a little bit of that happening. Now, the problem is that this is a very fluid situation, and it's difficult to actually assess the risks because decisions to escalate or de-escalate haven't even really been made yet. One big change of strategy can make all risk assessments on the situation completely flip. So I think overall, if you're looking at these analysis points on why the markets rallied last week, it's not really saying that, oh, inflation is going to be curtailed by the Fed, or, oh, COVID is no longer scary for the market, or geopolitical risks are going down, or oil prices are going down. It's really saying that on a spectrum, markets thought there was some improvement on all those categories last week. And over the long run, these are the things that are going to drive, for the most part, the markets. Okay, next. So our Mullen video on Thursday was one of our best performing videos in a while, both in terms of views and click-through rate. And it's interesting because this year has been mostly bad news after bad news for the markets, and you really haven't seen much interest in even the good plays when they came up, and those didn't come up very often. But increasingly the last few weeks, you've been seeing a huge return of folks interested in hearing about not just short-term plays, but all types of plays. The trend kind of started off with the energy trade and some of the spec energy stocks, and then all of a sudden within the last week, you've gotten all these new ones, which is encouraging, and we'll do our best to keep bringing you content based on what's relevant and hopefully helpful. But in terms of Mullen specifically, this is a stock that we've been watching and following since back in November, and we've briefed on it many times in ZipU over the last few weeks. But my thought process on Thursday was, hey, yeah, this may be a very good catalyst hype play, based on some progress they made on their battery and infrastructure, based on current hype, most importantly, short interest, and overall certainly attention. But I thought the long-term prospects were pretty rough because this is a cutthroat industry. Even the best, most experienced, and well-capitalized players are going to struggle in it. And we looked through their liquidity, and their liquidity is awful, and they had some pretty damn predatory loans. And we talked about how, in my opinion, they're going to need a massive influx of capital in order to operate and scale in any meaningful way, or even to operate as they have been operating. But still, as a hype trade, you're getting so much attention flocking to Mullen right now, and it just went parabolic over the weekend. It's now the #1 stock on StockTwits as a ticker with the most messages in the last 24 hours, above even the S&P 500 tracker SPY, and it's now #3 on Reddit according to Ape Wisdom. It was at #6 when we talked about it on Thursday night, and in terms of the price on Friday, it broke out again on Friday, going up to $320, and given the attention, the low float, the high short interest, and a lot of the increasing passion for the stock, obviously I could see how a lot of folks are excited about this one and how it's become kind of a self-fulfilling prophecy. At the end of the day, we've been talking about Mullen as a fun catalyst trade since basically the end of February when they had that battery announcement. There's a lot of folks in our audience, or at least folks that came over to the channel to watch our Mullen video, that have more of a long-term outlook on the company based on either things they've read or researched, or just based on what the company has told them. And they felt that covering it as a short-term trade because of hype and risk was not really fair. So I wanted to go ahead and address the big criticisms here. Okay, the first one is on Mullen and Apple. Mullen is nearly guaranteed to be bought out by Apple for the Apple car. Look it up, there are pictures. Here's another one. If Mullen wasn't financially sound, Apple wouldn't have made an offer to buy it. Charlie doesn't know how to There's no Apple partnership or takeover attempt evidence anywhere. The most evidence you have out there are these pictures from a Mullen stock group where it shows an unofficial, unconfirmed Apple car concept versus the Mullen 5, and it says they look similar, and thus the inclination is perhaps they are going to be working together and Apple is going to be in a partnership with them. I went to a lot of different forums to see different opinions, and there's a lot of people that upvote posts saying that they're going to go into a partnership, and then people kind of take that as evidence, I guess. To be fair, there were a lot of trust me bro citations, which some people see that as fact, some don't. Now, don't get me wrong, I think that loosely put together rumors on partnerships or takeover attempts does help with the prospect of driving hype momentum and people to kind of FOMO buy in and help it go up. And I also think that people like to make fun but totally inaccurate speculations on stocks that are heavily shorted to try to get more interest in them so that their own positions can go up. But please, folks, don't get confused with a lot of this fake news. It's totally fine to trust people, but always verify. Okay, #2, and this is one of the ones that got commented on the most. I said I seriously doubt their ability to raise enough financing and improve their liquidity without substantially diluting shareholders or taking on really bad terms on debt. Again, they had a net loss of $36.5 million-ish in the last report. Meanwhile, they reported about 45.5-ish million in assets. Pretty simple math. You could see that if they don't bring in substantially more capital, they're not going to be able to operate at the pace they are operating at, nonetheless meaningfully scale up to meet production goals that are a couple years out. I got a few comments on this one from concerned viewers. They said they applied for a $450 million loan, which you failed to mention in your video. Curious as to why you would say the only way of raising capital is to dilute when they have applied for a $550 million loan. Another one says, seems they are looking at a government loan for $450 million. And then someone else responded, looks like they already got the loan. So no, they have not gotten the loan. But I did make a mistake in not talking about this one in depth. So context, Mullen applied for a loan via the ATVM program. ATVM is a government program that was funded by Congress in 2008 to help provide loans for the automotive industry that could help vehicles manufactured in the U.S. meet higher mileage requirements and lessen U.S. dependence on foreign oil, with a focus on qualified components that support electric vehicle manufacturing or other alternative forms of energy for manufacturing and transportation. So far, it's been given to Ford, Nissan, and Tesla, according to the government website. There was also a conditional commitment given by the Department of Energy to Fisker, which ended up defaulting and losing access to the full amount, and some smaller energy projects. But the program has not issued any new loans since 2011, according to Wikipedia. The loan program has been applied for over 100 times, yet less than a handful of the best players in the industry have been approved. And the reason is because the eligibility criteria is brutal, and this gets into why I didn't talk about this loan. We can go line by line, but the biggest problem for Mullen is that, quote, an applicant must demonstrate that it has sufficient funds to carry out the project and is not dependent on other federal support as described in the applicable federal regulations. And then you go to the application itself. In order for an applicant to be eligible under the ATVM program, the applicant must be financially viable without the receipt of additional federal funding associated with the proposed eligible project. And a lot of people have reinterpreted this on different social media sites to say, oh, Mullen qualifies because they can become financially viable with the loans. The problem is that they have to be financially viable before they get the loans, not with the loans. I understand that this is a big debate and a lot of people disagree, but ATVM themselves literally addresses this word for word. Can funding from the ATVM loan program be included in the determination of financial viability? The answer is no. Funds received or anticipated to be received from the ATVM loan program itself may not be counted when determining financial viability. Now, obviously, a lot of people have looked at this and tried to reinterpret it again to say, well, yeah, but we feel like Mullen should be an exception despite all the other companies that this government program has turned down. But again, if you're going to be honest, that is not what this says, and they were very, very clear about it. You can reinterpret it to get people hyped up on the stock, but again, that's dishonest. In my view, and in the view of anybody who reasonably takes some time to look at the guidelines for how you qualify for this application, Mullen right now does not qualify. The other thing is that a lot of folks on social media and on YouTube specifically are spreading this information like Mullen will get the $450 million loan. No disrespect to any creator that shares their opinion, and it's tough work making these videos, let's be real. But this one from Moon Market, which said that they're going to get the $450 million loan, cited an article from Mullen that said that the results from a comprehensive 6-month EV market exploration study and conceptual benchmark test indicate that the Mullen 5 is conceptually highly competitive with the Tesla Model Y and Ford Mach-E. And then it says results will support Mullen's U.S. Department of Energy ATVM loan application for $450 million. But here's the problem. If you go back to the loan application and you look at the fine print, it specifically states that applicants should note that in all but the most extraordinary circumstances, market analysis in parentheses, studies will not be sufficient to establish a high level of confidence that adequate future sales will occur. But yet somehow a 6-month EV market exploration study is supposed to help this loan application. It just doesn't make any sense. A lot of people say it's fun to look at the actual fine print because who reads the fine print? But you cannot accept word of mouth as proper due diligence. It's totally fine to bounce off other people and their ideas, but you have to look at this yourself. This is another example of be nice to everybody who shares their opinion. Trust, but verify. People are grasping at straws with the speculation, and then people are building on that grasping of straws by going and throwing out this information all across social media. A lot of people will go and buy based on this information, and then the information wasn't even real, and they're going to get their rear end handed to them. Sure, maybe something changes and the Biden administration decides to reopen the eligibility criteria, but it doesn't seem like they're looking to do that at all. It seems like they're focused on just Ford and GM. The guy didn't even want to mention Tesla until recently. He said that Ford and GM are the most revolutionary players. But anyways, all this huff and puff would be useless if I didn't acknowledge the elephant in the room here. I'd argue that Mullen is a target of predatory lending, extensive short selling, and probably some shady market practices similar to what we've seen with other squeeze stocks. Which from that standpoint, retail is serving as a bailout for this company, and it's helping it a lot. Mark my words, if retail buys the stock up enough, Mullen is going to go and dilute heavily shareholders, and they're going to use that to actually become a more viable company. What is going to make Mullen competitive is retail bailing it out. We've seen this with a lot of short squeeze stocks. Retail traders will go and try to bail out a stock that's been shorted to oblivion, usually using unfair tactics, honestly, and they'll help rally it up, but the company will reward them by diluting heavily and using that capital to go and actually make their financial situations better. Pay off debt, invest in diversifying, and also usually insiders sell out a ton of shares. Now, obviously, retail traders would say, well, we're sticking it to the short sellers, but a lot of the time, the enemy isn't just the short sellers, it's the actual company itself and the people who are running the company. And a lot of people say, Charlie, that's FUD. It's only retail versus short sellers. But no, it's not. Anytime somebody else is making money off your backs, you have to think, are they providing you real value, or are they just trying to enrich themselves? Short squeeze stock after short squeeze stock has gone and taken advantage of the retail traders that hold it, yet people still think that they're buy and hold plays. You do not buy and hold a company that is not actually using your money to create more value for you. You buy one that you believe is going to be able to invest that money in growing their business, not in bailing out their own dumb moves. At the end of the day, I believe if you're going to buy and hold Mullen stock, you have to go into it with the mindset of, okay, I'm going into this to bail out the company. I don't care about me making money. I care about bailing them out. And maybe 5, 6, 7, 8 years from now, they will still be in business and they can return something. But don't think for a second that Mullen isn't going to dilute you to oblivion the minute they get a good opportunity. At the end of the day, folks, we've analyzed a lot of stocks on this channel, and some of my opinions have been very, very unpopular, especially the ones that were negative on stocks. I remember making a video back in September 2020 criticizing Nikola. And we talked about the allegations. And I highlighted some ridiculous moves like the CEO who appointed his brother to an incredibly important position as director of hydrogen production and infrastructure, despite that same brother only having relevant experience in construction and driveway paving. But a lot of folks now, similar to 2 years ago, are saying Mr. Charlie Man is just spreading FUD. But a year later, they got hit with huge fraud penalties for a host of different issues. And at the end of the day, a lot of people are arguing with Mullen, hey, you don't need to have relevant experience. You don't need to have good leadership. You don't need a track record. You don't need capital. You just need to loosely put together rumors and speculation on things that haven't been confirmed. And somehow it's just all going to work out at the end of the day, and they're going to be able to survive in one of the most competitive sectors out there. And for me, I just don't think that's an appropriate view. I don't think they're necessarily a Nikola, and it seems like the company's trying to do their best. But at the end of the day, I would say that this is a hype play, and that's about it. Hopefully I'm wrong, but until then, enjoy the hype rallies because they can be quite fun. Just make sure to control your risk and understand that one little announcement can derail your position. Tight stop losses, tight risk management, folks, at least in my opinion. Anyways, have a good one, and we'll see you in the next video. If you'd like to learn how to trade with our step-by-step lessons, our private chat, our daily morning briefings, as well as our price targets, I'll put a link to ZipTrader below, along with coupon code NEVERGIVEUP. And if you'd like to get 5 free stocks plus 1 share of NEO when you sign up and deposit with Moomoo with our link below, we'll also put that in the description. Have a good one, and we'll see you in the next video.